Okay, so this session is SDR 1 year on, or SDR labelling 1 year on. And I picked on the labelling bit because a lot of fund managers have had a pretty bruising time trying to get labels. So it's really important to me that we get this recorded as to what the issues are, and that it's great that Louisa's come early to hear, so maybe pick up some of it when you're talking. I think everyone here probably knows Louisa, but so let's kick off. If I can ask you maybe to just introduce yourselves to start with, please. Jen.
Hi, good morning, everyone. I'm Jenn-Hui. I'm the Chief Sustainability Officer at Fidelity International.
I'm Miranda Beacham. I'm Head of Responsible Investment at Aegon Asset Management.
I'm David Harrison, Head of Sustainability at Rathbones Asset Management. Right,
that was short and sweet. Thank you. Okay, it was, right. So look, the first question then, or the first topic I'd like to cover is, you know, what's your experience? Have you got any funds that have been labelled, unlabelled with sustainability characteristics? What routes did you opt for, and why, and how did it go? So this is probably the main question we're asking here today. But Miranda, I'll come to you last, shall I? For those of you who know Miranda, you'll know why I've just said that. David, shall I start with you? Is that okay?
Absolutely. So we have 6 labels, all sustainability focus. You know, probably given our size, we're about 16 billion assets under management, and we have the same process backing the equity, bond, and multi-asset. I'll come back to kind of the process later on, but yeah, we opted for the same focus label because I think it reflects what we do, and we're quite consistent. And potentially we'll be looking at further labels for our ethical bond fund, and then Miranda will talk about that as well. And we finished up on this stage of the process in April this year.
Yep. Do you want to say any more about how it went, or you? I mean, it took time.
Yeah, it was. I think like others, and you know, we spoke to Louisa, and that was incredibly helpful. There's all the stats that I think we went through 14 rounds of questioning with the FCA. I'd say we learned a lot. I think there's benefit of the process, particularly how we articulate our standard of sustainability. Many of you know Greenbank and Kate Elliott. We spent a lot of time thinking about how do we express this, the scoring system, so we developed more of a scorecard. And I think probably the challenge for us was that we're multi-thematic when we think about sustainability. And we found early on adapting perhaps was more focused for the label for multi-thematic. That was the biggest challenge. But I'd say, you know, the benefits for us outweighed those challenges, particularly around the articulation and really trying to solve the issue of solving greenwash and making it clear for people. So it was challenging but good.
Brilliant, thank you. Jen.
Yeah, so we have 10 funds in scope of the regulation. 3 of them are sustainable focus funds. 3 of them are mixed goals funds, so we're 3 out of the 5 in the market. And 4 are in the unlabeled with sustainability characteristics, which we refer to internally as our promoted range. And that is for a total AUM of $2.1 billion. The reason why we selected these funds is quite simple. It's because they were consistent with the investment process and with the clients that already were in those funds. And I think that was our guiding principle when we selected the funds that we wanted to be labeled and disclosed in that way. Were they consistent with the client expectations in those funds? In terms of our experience with the FCA, I think I would characterize that as rigorous and constructive. I think the FCA set a high bar. A lot of their focus was around disclosure and the standards that we used and rationales for those standards. So why did we choose a certain thing? Why were we measuring things in a certain way? You know, and I think all of that has contributed to and will contribute to better transparency for retail customers in the future. You know, I want to say, I think that any early stages of these types of discussions involves a degree of interpretation. And when you have something that requires interpretation and balance, there's always going to be views about whether you're too hard or too soft, whether you've set the right approach. And I think this is normal. My expectation is that in the future, it will become easier and quicker because as the FCA publishes examples of good practice and bad practice, it will be more obvious what is and isn't okay. I think, yeah, maybe I'll stop there and I'll pass to Miranda.
Do you have any funds that are unlabelled with sustainability characteristics?
Yeah, we have 4 funds in that category.
Okay.
Well, we've got 5 funds that are in scope. 2 of them are sustainable focus funds, and 3 of them are ethical. So they sit in the unlabelled with sustainable characteristics. The process was long. It was painful. There was a lot of back and forth. I'm like Julia, I absolutely believe that this is a good piece of regulation. I really do think that this was needed at the time. We needed greater clarity, we needed greater choice, we needed greater trust. And I think that is good. How it was implemented was probably not ideal. And there could have been a lot of improvements in how that was done. And hopefully, lessons have been learned and it will be easier going forward. I think what we need to do, though, is it's possibly a little bit of a lost opportunity. I had quite high hopes for this. There is a good market. This market's been going for decades. We've had ethical funds since 1989. But it's not really lived up to expectations. I've got the numbers from the IA, they're slightly different to the ones that you had. Roughly 150 sitting in the labelled and 350 sitting in unlabelled. I mean, that is a missed opportunity. Those ones sitting in that bucket of 350 are a real soup of different types of funds that I do think most of them are leaning more towards sustainable funds. And so I do think that something needs to be done to kind of sort that out. But I think that's a kind of slightly easy route out for some funds. I mean, the ethicals, they don't have a space. They don't have a category, and we've talked about that at length, and I would love that to be fixed, by the way. But there are dozens and dozens of funds sitting in that box that possibly could fit into one of the other labels, but because it's been quite difficult and very costly to get a label, and there's not the demand from clients at the moment, because the overseas regime, because the portfolio management services have not been, then it's not worth it. So, I think it's a little bit of a missed opportunity, but I still believe it's a good piece of regulation.
I mean, it was always a massive ask to come up with something that would address the whole market. But yeah, I mean, there are areas for sure that could have gone better. I'm wondering, actually, I've just remembered something else. I should have done better in my introduction initially. So you've got various bits on your chairs, including obvious things like feedback forms and a free pen and a badge and whatever. But you've got red cards there. If anyone says something on the stage that you don't understand, particularly if it's jargony, please wave your red card. And we've got mics, hopefully both sides of the room somewhere, maybe. And we will come and get you to ask your question and say what it is you didn't understand. So you're welcome to ask questions at any time. We will, there's a, oh no, not asking for a mic. So I do want to keep this interactive, please, if we can, because it's only by building that understanding and making sure that we've got the language right and everyone knows what everyone's saying that we're going to move forward in this area, which, rightly or wrongly, I continue to believe is so important to everything. We can't solve all the issues we face without people like these guys being on board and without people like you then understanding it and being able to talk to your clients about it. So the red card is an important part of the event, so please use it. But also, even if it's not a red card calling someone out for using too much jargon, if you just have a question, please stick your hand up. So I'll pause there for a moment and ask if there's any initial. Frank, there you go, red card.
Thank you very much. Shall I wait for a mic?
Zoe's just coming. Yes, please do.
Thank you very much. It was really interesting hearing your experiences from a policy supervision sort of interaction. The one thing or 2 things I wanted to point out is SDR labels are voluntary for asset managers, which is a shame. And the second bit is that SDR is for retail customers. And yet so much of what the asset managers do is institutional in terms of their mind. And I think it was really pleasing to hear from the panel that they were thinking about what the consumer and their advisor actually wants. So thank you very much for that.
Cool. Yeah, all good points. Thank you.
I mean, maybe I can sort of just add a little. I think we all recognize that this is a very fast evolving space and that standards are being created all the time. There's new ways of interpreting sustainability. I think you've got the challenge on the one hand, you don't want to lead the market too much. You don't want to say, this is what good looks like. everyone only do this. But at the same time, you don't want to stifle innovation. You want the market to continue to expand and for managers to be thoughtful about these things. So I think that I think is the right balance. I think the regulation has successfully reduced incidences of greenwashing. I think that was the key finding from a survey conducted by the Investment Association of its members, that members broadly agreed that it had achieved that, and I think that is critical to restoring that trust that you talked about, Julia. I think for us, we don't see the effort and the energy we put into our labels as a waste of time at all. I think we think it's a long-term investment and a commitment that we've made to this space, and to seek more label products in the future for categories that are a bit more challenging perhaps, like fixed income, like passives and so on and so forth.
So I'm going to touch on for a minute and maybe give Miranda and David a chance to think about it for a moment, but I want to come back to it's optional. I mean, the naming and marketing rules aren't optional. You've got some rules as to what you can and can't do there. And the anti-greenwash rule is not optional. I mean, I almost don't like the fact it needed a name because it's just clear, fair and not misleading, and then everyone's comfortable with it. But for some reason or another, people just thought, oh, it's sustainability, it's that green stuff, who cares? And that was just infuriating for me, a bit of a red rag to a bull for me. So, voluntary, yes, but you can't force a fund to focus on sustainability, or at least not yet we can't, maybe one day. So voluntary but not voluntary. I don't know if any of you want to comment further on any of that, or have I covered it?
Yeah, you kind of have covered it. Obviously, the rhetoric against sustainable at the moment is such that possibly it's not gaining as much attention as it should have. But for those of us that have been doing it for a long time and we believe in it and that's what our businesses are built on, we don't really have a choice. If we want to talk about it, you don't really have a choice. So yes, it's optional, but if it's ingrained in your business, then it's not really.
And bear in mind, there's a number of funds that live and breathe it, and it's what they do all day, every day, and they're completely brilliant at it, that haven't got labels yet because they haven't made it through the process. And for them, business-wise, it's not optional, but it's not worked out yet. Remain hopeful. There's no wood here. Here, there you go. Issues around optional. Some fund managers think more optional than others. Were there any further comments before we move on about sort of highs and lows of the process, or anything you'd like to comment on that?
I'll maybe go linking back to your slide, Julie, you put up. Actually, I think it's good this is done now when perhaps it's slightly out of favour. You talked about the bubble, and I remember going through that as well, all of us did. And some of the funds that were launched and things that were said, we go through this now because you can see the tailwind's coming back in the space.
Yeah.
And it wasn't addressed maybe 3 or 4 years. That's why I think the net positive is much better. And to Jen's point, we'll learn, we'll adapt. So I think that there are a lot of positives to take.
Thank you. Yeah, and can you imagine being in the Trump era with funds that can't be trusted? Yeah, Miranda, please.
No, much the same, really. Not really much you can add to that. Let's take this time. We've got breathing space. Let's get it right.
Jen, did you want to add anything, or are you good on that? Okay, so what was my next question? Current thoughts on the labelling status generally. Miranda, you touched on unlabelled with sustainability characteristics. Shame there isn't something that brings them into scope more. Did anyone have any comments you'd like to add on, generally how the status situation is working, what should be, within the space? Any other thoughts on that? Or shall I move that one on?
So I think maybe I'll just divide that into supply side and demand side. And I think on the supply side, as fund managers, we're keen, all of us are keen to get high quality product into the market as quickly and as efficiently as we can. So I think speed of approvals, ease of interaction, I think that's an important consideration for us. And then on the demand side, this is a challenging time for sustainability funds from a performance perspective. We know how the market is being driven through the AI boom, through defense, through energy. This is not the right conditions really for sustainable funds to prosper, but the cycles always do turn, and we're keen to be positioned for that. We think there is more work that the FCA could do and all of us could do to help to bolster that demand case for sustainable funds when it does come back, not least because it addresses some critical systemic risks that we know we all face.
We've also got a little bit of an unlevel playing field with the overseas funds. So, that's causing a little bit of difficulty for all of us, I'm guessing. That, funds created out of Europe can talk about this stuff quite freely, and yet the ones that we choose to label and go through that that long process, have to be quite careful about what they talk about. So, I think that we really need to address that at some point.
Yep.
And I think I'll probably add, it might come back to later on portfolio management, the interactions we have with wealth managers, but there's so much interest, and then I think to bring that legislation through, that would be very helpful from a demand point of view, because I think typically everyone in the room, everyone's extremely busy, and it's something that they perhaps not lose focus on, but just move on. And once we have the legislation come through, I think that will help from the demand side a lot as well.
Yeah, I think that's massive. So that brings me on to the next question, which is what can be improved. And to me, that's the big one. But obviously, until the offshore overseas regime bit gets sorted, it's really hard to do anything on portfolios. But is there anything else that you could see that could be improved to make this whole area work better, to get this bigger cohort that we need in order to give the portfolio managers more to look at? Any comments, Miranda?
I'd love the ethical funds to be labelled.
Cool.
Yeah, I'd add that ethical for us, but also I know that you released quite a lot of best practice work, and we felt that was very useful just to develop that, and probably the regular interaction with the fund managers. We found that very useful to talk, and share things. I know Miranda mentioned it as well, because then any misconceptions that we had would be cleared up more quickly.
Okay, now as you both sort of said the same thing, Jen, can I come back to you in a moment and just dig a little bit deeper into this? If it would be helpful for the ethical funds to have labels, that sort of begs the question why, and the extent to which sustainability is involved. Can we tidy that one up for people, just in case there are some questions?
Yeah, absolutely. So I was at the UK SIF conference yesterday, and they did their own study, as they always do, the survey, and a lot of the results that came out were really reflecting on the fact that if you ask people what they want, then it genuinely goes towards what they don't want. And there was a couple of wealth managers on talking about there's a bit of a resurgence in ethical. They are completely unambiguous. And it's just a very natural consequence. If you don't invest in a lot of harmful companies that are harming the environment or society, then the consequence is that you are actually investing in some pretty good, quite sustainable companies. So I think there is a space for them. They're maybe not as intentional as other sustainable funds, but they consequentially are investing in a lot of good businesses. So, I think there's a space for them.
I agree. I think the same thing, that there's absolutely demand, and sometimes what we hear is the pure label sustainability funds, they are quite narrow, and to Miranda's point, about the outcomes for clients, I think there's a huge role and lots of demand as well.
Jen, would you like to come in? Or you, or shall I stick on this one for a moment then? Just say, so a lot of the training I've done people, bear in mind, I've been training people on this stuff and running stuff since 96, I think, 97 maybe, I started specialising in it. And one of the ways I always explained these funds was to say you've got two sides of the same coin. You can explicitly go out and look for good things, or you can avoid all the bad stuff. Now, it won't necessarily get you to exactly the same holdings, but from a client's perspective, a lot of the time it's very, very similar in terms of the holdings. So if we look at them as being completely complementary and just a slightly different lens to look at this area through, I personally think that's helpful. Shall I come to Jen now on labelling? Jen?
Do you know, I guess it comes to what you think the purpose of the regulation is. I think there's probably less confusion in the marketplace about what an ethical fund is and how they operate. And they definitely serve a purpose in allowing clients to express their own personal, explicitly moral objectives by definition. And by definition, everyone's moral objectives are going to be a little bit different from each other. So we express that through having a systematic-based approach that allows for more individual expression of those ethical views, recognizing the proliferation in that. I think sustainability is perhaps...
Jen, can we hold off for 2 seconds? We've got a red card there that Zoe's going to. Someone didn't understand, or has got a query. Please go ahead.
Yeah, possibly don't understand or possibly slightly disagree. To my mind, the benefit of the sustainability labels is partly in, we would major on stewardship and engagement. What we really need is real change in the real world, right? So how are we going to get there? And the benefit of the labelling regime is it makes you guys articulate how you think engagement plays a part in that. Where would you see a place for that in an ethical label should one come about? Because simply excluding, we might all agree may have very little effect in terms of getting any actual real change. It cleans up someone's portfolio, but has anything actually changed out there? So would an ethical labelled fund still lean very heavily on engagement, and should that be part of the criteria if a label was to be designed?
Yep. Okay,
Ethical
Miranda.
funds absolutely do rely on engagement. You know, they rely on what do our clients want? And we actually go out to our clients every 2 years. We ask them exactly what they want. You know, are they happy with the criteria that we have set? But it's not just you can buy that stock and you can just sit in that stock and you're never going to talk to them. We rely very much on engagement. And actually, in the past year, I've spoken to companies about their kind of transition process, because although you're not holding the fossil fuel companies and the worst of the dirty industries, you're still holding companies that need to address climate change. All companies need to address climate change. So we will engage with them to try and improve them on their transition pathways. I've spoken to companies about living wages and implementing, you know, much fairer practices. I've spoken to many, many companies about remuneration and board structure. So ethical funds aren't just buy, hold, and never do anything with them. Engagement is a very key part of most active manager strategies anyway. And so I do believe that they are making that change as well. They're just making it through a slightly different lens, and one that is very easily understood by a vast majority of customers. And when you look at the Financial Life Survey, and you look at what UK SIF did yesterday, there are a lot of people that are very determined about what they do not want to have in their portfolios. And so yes, there is space for engagement, but there's also space for exclusions as well.
And to my mind, though, you'd still have to have a clear sustainability message in the fund, otherwise it's not part of the sustainability regime. But clearly, Miranda's ethical fund is avoiding sustainability nasties and favouring those that are the better. Jen, I'll come on to you now.
For what it's worth, I tend to agree with your perspective. I'm not saying that engagement shouldn't be part of an ethical fund. I think the orientation of an ethical fund is to take a moral view, a moral judgment on the approach. A sustainable fund is intended to create financial value through the same set of tools. So I think it's kind of, you're sort of looking at it from a slightly different lens here. But I don't think it's, I come back to this, what was the purpose of this regulation? It was to clean up a space on which there was a lot of confusion around what good practice represented. I don't think there's a lot of confusion around what good ethical practices are, not least because all of us have our own sense of ethics. What do we think is right and wrong? And it's probably not going to be the same for people in this room. So that to me isn't necessarily a source of confusion, but sustainability, engagement, the standards that managers set, the outcomes that we generate, all of that has been subject to a lot of debate, and I think that's where the FCA have rightly focused their time. You know, that's not to say that this is necessarily the end of the story. On overseas funds, really quickly, so the landscape for overseas funds has also changed, because with the new regulation from ESMA, the European Securities and Markets Association, and upcoming changes to SFDR, they now have a set of standards as well. It's not the same standards, but I would say, I would characterize it as being a different playing field rather than a lower playing field, I think. And I think that's perfectly okay, as long as you are clear and transparent with your customers about what those differences are. You have a clear warning label. You say, this adheres to this set of standards. This adheres, if you want the UK standards, here's your product, here's your transparency, here's your label. And exactly to your point, that's what's important to the retail investor. But if you're okay with a different set of standards and you understand how those are applied, then do that. And so, to my mind, a lot of that is solved just through clear disclaimers, clear, yeah.
But I'm going to throw in one extra comment, and Miranda will probably then build on it, perhaps. So engagement, I've spent since the 1999 amendment to the 95 Pensions Act came in, I've spent a lot of my life talking about engagement and the benefits of stewardship. So I'm not someone who opposes it. I think it's vital. But if these funds were all about engagement, then how would that work with the thematics? You know, how would we get the specialist funds in this space? It's got to be a broad church. It absolutely has to be. And a big chunk of it is about reallocating capital, whether it's towards, you know, clean tech companies or, you know, leaders, or whether it's just companies that are significantly better than others. You know, it's got to have that broad broad view, otherwise there just won't be the cohort. I mean, there's not enough people that care about this stuff, so let's get all the people that care about it all working together, shall we? Miranda, do you want to?
There is all that, but the other thing that I would point out also is that if portfolio management services is brought in, it does cause problems in that the ethical funds would not actually fit into any kind of collective portfolio. That's not right. These are good funds. They are very clean funds. And so there needs to be an ability for wealth managers, et cetera, to build portfolios out that will include a broad church, because there's not enough funds at the moment anyway, to build out a meaningful portfolio for their clients.
But also some of this is a timing thing, because I worked on these funds when everything was called ethical, and the first fund I was involved with was the MPI Global Care Funds, and they were clearly all about sustainability. That's what Tessa Tennant, Mark Campanale, some of you, if you were here last year, will have heard Mark talking about all the work he does on carbon. They were just called ethical. So to some extent, some of those funds they're called ethical because they're called ethical. And so that's why I like the broad church. So long as there's a clear sustainability message, it's doing good. But anyway, I'm probably not meant to be expressing those opinions as chair, am I? Over here, we have a question, George, if the mic, please. George, this. Yeah.
Thank you. So 2 questions for the champions of the ethical label for Miranda and David. Is it one label that's just ethical, or do you think there should be a range like there is with sustainability? And then secondly, what happens when you have it and you've got a fund with a sustainable label that could probably be in the ethical label, and how do you decide?
Well, I guess there's funds that would fit at the moment, depending on which way you frame them, into one of any of the labels. So you have to pick your lane. Pick your lane, it's a disclosure regime, describe how you fit that label. My opinion is an opinion that I did share with Louisa, I don't know, you might not have been there at the time, is that the ethical funds could in fact fit in a focus category if you said that your ethical exclusions were the actual standard that you were sticking to. So there is an ability that they could fit in there if there were some slight modifications. Other than that, there could be another label that was values-based, because there are quite a few values-based that are not just ethical, they're faith-based, etc. as well. So there are a couple of ways it could be solved, in my opinion. I don't know if David thinks that.
Yeah, I agree. I think my preference would be that we've got the labelling regime not to add more, and we find a way that might be not more difficult to achieve, because I think it works really well, and more labels might become confusing. Particularly to someone who doesn't look at this day to day, I think it's very clear at the moment, but I agree with Miranda, I think there's a way we can do it. And certainly when we talk internally, that's where we're looking, how do we adapt, how do we think about this? We've left it for now, but it's something we're coming back to. But my preference to be in the existing labelling regime and to make it work.
We have a couple more questions. If there's a lady there, and then the gentleman in the middle here. Hi, Suresh.
Thank you, first of all. I just wanted to ask, what demand do you see for the SDR labeling or other labels, and how did it change from the, let's say, last or 2 years ago?
Any offers, Jen?
So I'd say anecdotally, we're getting a lot of client interest, a lot of requests, not a lot of flows. And I think the success of these products is going to depend on their ability to deliver really not just on their sustainable element of their proposition, but on their financial element of their proposition. Fundamentally, the industry is interested in risk-adjusted returns. And these vehicles have to deliver that, or there won't be a future for sustainable or ethical or any sort of other labeled funds. So I think we're very acutely aware of that, and I think that's where we choose to spend our time prioritizing.
Yeah, I would agree with that. I think the products that we've got the most interest in at the moment are the climate transition products. They are actually out of scope since they are not domiciled in the UK. So there is a kind of slight shift in where interest lies at the moment, and that is just because of the environment that we're in. But we're in a little bit of a lull. This is a good opportunity to make sure that we are doing things right.
Interest, absolutely. We held a couple of events where there's a lot of interest, and Julie, you came along, and we're starting to see some flows, but sometimes the feedback is that I'm waiting for the the legislation on my side before I build a product, or I can build a product. And the point's been raised as well. It's performance-led, risk-adjusted performance. But people are interested, and it helps a lot. But it's very much that's a 2026 issue, I think.
I think that's right. And I see one of my missions in life to hopefully try and help Louisa not make that too complicated so that it's actually achievable and stuff that at the end of the day, if the end clients don't understand it, it's no use. So we've got to make sure the clients understand it. I think there was a question in the middle, Suresh.
Question for the whole panel. Through the SDR process, how many of your funds had to change the investment process they were actually employing, or was it mainly a case of changing how it was described? And did any of your funds actually get to a point where you just felt, actually, it's not going to meet the standard, the label standard, and so you just stopped?
I can say that we didn't have to change anything. We slightly tightened up the way we described the process, but our actual process was not changed at all.
Yeah, so Fidelity is a pretty broad church, and we have a lot of funds, and the funds that we selected for the label were funds that we felt were very well aligned to what the FCA were asking for. And so we improved our disclosures, we improved the transparency of the process. And actually, I would also say one of the effects of the FCA's rigorous examination was to help us to lift our own standards, which I think is great. So I think we have a situation now where our Article 9 SFDR products have all, broadly speaking, been labeled for the UK market if we think they are, if there's a commercial proposition for that. So I think we've found a semblance of that equivalence, I think, if you like. And yeah, I think we're looking forward to introducing more product.
Cool.
Yeah, similar for us. No change to process. The one thing we decided early on and was probably that ethical will leave for potentially round 2. We just focus on the sustainability labelled funds, but that ethical to come back to, which we've already talked about.
Yeah, and I'm going to say a few words for those funds that haven't got through the labelling process here, that some of them really do feel like they're being asked to change what they do, and they're not happy because they've sold their funds on a particular basis. You can't upset all your existing clients. That's just, just not, it's commercial suicide. So that's the general pattern. Can I ask you very quickly in the last couple of minutes for any closing thoughts, hopes for the future? And then if we can do that maybe in a few sentences, then see if there's any final questions. I think our clock here is slightly different from what Rob's telling me. So we've got 3 minutes. Who would like a question here?
But also before that, maybe just a comment that the assumption that if you have a fund that excludes certain activities, that being the other side of the coin from funds that go out and proactively look to support positive activities, that those arrive at the same point. That might be true in some asset classes, but from a history of running an emerging market equity sustainability impact fund, I'd say that I find that assumption quite alarming. I think they're very, very different end results in terms of the sorts of investments you end up making. To Jenn-Hui, I wondered, you made the point about the Article 9 funds moving across and getting a label. Will they be moving to sustainability impact? And if you are not trying to make that equivalence, can you comment on why not? And the second one, I'm afraid, back to you as well, was on improving risk-adjusted returns. One of the observations I guess I have from the bubble was not just around the fact that there was greenwashing and claims of activities that people couldn't stand up to, but also that factor risks went completely unfettered. And that's part of the reason that investors have a certain level of concern about sustainable funds. Could you comment on what exactly you're doing to drive the better risk-adjusted returns? Is it a change of process, or is it a change of maybe benchmark?
Yeah, so both great questions. So the first thing I'd say is I'd agree with your starting proposition. I think there is a world of difference between funds that are just looking to stay away from bad places versus funds that are trying to lean in and solve that. There's a market for both, and I think that this is ultimately all about client choice and client preference, but these are not the same equivalent approaches, and they should not be treated as such, in my view.
Can I jump in and say it's a far from perfect analogy, and as the markets become more sophisticated, that's not something I really say particularly now, but it's worth remembering, though, that you can get to, depending on your strategy, you can get to similar cohorts. And yeah, so it's, yeah, imperfect analogy, point taken.
So your question on the Article 9 equivalence was, whether we would seek an impact label for those funds. We've been, so part of the mixed goals thing is to demonstrate your ability to integrate any element of that into mixed goals. So I think to some degree, you have to prove out your ability to do that. We only have one impact product, which sits in our real estate space, which is where you have a physical asset where it's relatively straightforward to demonstrate that impact. Impact in public markets is, to our minds, a different question altogether. Range of different views. We would rather not go there for now. I think there's plenty in focus, improvers, and mixed goals for us not to have to worry too much about, would we call this impact? And I know there are probably some people much deeper into impact in this space than I am, that I'm probably oversimplifying, but it's a space that comes with its own intellectual framework. On your question on what we're doing about risk-adjusted returns, so yeah, I think it is about balancing out the different sector exposures. It's about thinking more broadly about what can and can't be a sustainable investment. It's also about being very frank, just improving our fundamental security selection. One of our climate solutions funds is actually doing very well now in terms of performance. And one of the reasons for that is because we've broadened its focus to adaptation and resilience. And we've therefore given it, previously it had quite a narrow approach in sort of tech and utilities and people making good things. But now it's looking much more broadly at what companies are more resilient and are creating solutions around physical risk. And I think that has also improved its performance.
Right, I'm going to have to jump in here. I'm sorry. Just we're out of time. And can I suggest that the conversation carries on in the coffee break and in the lunch break, and hopefully drinks afterwards. Hopefully the speakers are staying, but if not, either way, can I ask you to thank them in the usual way, please? Thank you.